Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets of the business world in plain English. Today we're diving into LAGO Evergreen Credit's latest quarterly report, their 10Q, and let's just say they've been busy bees managing investments and growing their portfolio. Stick around because we're going to decode the numbers and tell you what they really mean for the company's future. Before we jump in, if you love getting clear insights from these dense financial filings, make sure you hit that subscribe button and ring the bell. We also have a fantastic community over on Discord to continue the conversation. Join us there, the link is in the description. Alright, so LAGO Evergreen Credit is a company that doesn't really go out and list its shares on a big stock exchange. Instead, it conducts a private offering to accredited investors, meaning people who meet certain income or net worth requirements. They're structured as a business development company, or BDC, which gives them certain operating and investment flexibility under US law. They started operating in March of 2025 after a merger transaction called the Formation Transaction, and since then they've been actively putting money to work in various businesses, as it conducts a private offering to accredited investors, meaning people who meet certain income or net worth requirements. They're structured as a business development company, or BDC, which gives them certain operating and investment flexibility under US law. They started operating in March of 2025 after a merger, a transaction called the Formation Transaction, and since then they've been actively putting money to work in various businesses. Let's get straight to the money. As of June 30th, LAGO Evergreen Credit reported total assets of over 111 million harbors. That's a pretty healthy starting point for a newer company. Where is all that money going, you ask? Well, most of it is tied up in investments. They're investments primarily in other companies that they don't control or are affiliated with, total over $76 million. These are spread across different industries, as we'll see later. Think of it like this: for every dollar of assets they have, about 68 cents is invested in these private companies. They also hold a significant amount of cash and cash equivalents, over $34 million. This is good to see, as it gives them flexibility to make new investments or just manage their day-to-day operations without immediately needing more money. Now, they haven't just used their own money, they've also tapped into a line of credit to the tune of nearly $24 million. This is common for investment companies to use leverage to increase their investment potential. Let's look at how they performed operationally. For the 3 months ending June 30th, they generated considerable investment income, around $2.8 million. This mostly comes from interest on the loans they provide to other businesses. After all their expenses like management fees and interest payments, they'd brought in a net investment income of almost $1.5 million for that quarter. They also saw a healthy increase in the value of their investments, an unrealized gain, which means the market value of what they own has gone up by over $1 million. This helped boost their overall earnings for the period. Now let's get into the nitty-gritty of where their money is invested. This is where we see the specific companies they've put their capital into. The bulk of their investment portfolio, close to $61 million, is in first lien senior secured term loans. This means they are lending money to companies and are in the top position to get paid back if something goes wrong. They also have about $8 million in second lien term loans, which are a bit riskier but can offer higher returns. They've also invested over $6.5 million in warrants. Think of warrants as options to buy stock in a company later at a set price. They can be a good way to get extra profit if the company does well. Looking at the industries they invest in, technology, marketplace companies are a big focus for them, with investments worth almost $13 million. Health and wellness is another significant area for them, with over $13.8 million invested. The crucial part of their financial reporting is how they value their investments. Since most of their investments are in private companies, there isn't a readily available market price for them. This means they have to use a process to determine what these investments are worth, and this involves a lot of judgment and estimation. Most of their investments, over $76 million, are classified as level 3 assets. This means their value is based on unobservable inputs, significant assumptions made by management, and it carries a higher degree of uncertainty. For their first lien loans, the key thing they look at is a discount rate. This rate reflects the risk they perceive and the expected return. A higher discount rate means they believe the investment is riskier, and vice versa. Changes in these rates can significantly impact the reported value of their investments. It's also important to note their commitments. They currently have over $52 million in unfunded commitments, meaning they promise to lend more money to companies in the future under certain existing loan agreements. They expect to fund these using their existing cash and credit lines. Looking beyond June, they've had some activity. They issued more shares in July, raising substantial capital, and repaid their entire line of credit with KeyBank. They also received a new exemptive order from the SEC, which allows for more flexibility in co-investing alongside affiliated funds, ensuring fair treatment for all parties involved. They've also been active in making new investments since the end of June, adding more companies to their portfolio across various sectors like tech and health and wellness. Now, for my take on all this, LAGO Evergreen Credit seems to be running a pretty active investment strategy focusing on private companies, particularly in tech and health. They've got a solid base of assets and a line of credit to help them grow. The fact that most of their investments are in level 3 means there's a degree of uncertainty in their reported valuations, but this is typical for BDCs investing in private markets. The real test will be how these companies perform over time and whether LAGO Evergreen Credit can successfully manage its portfolio and make good on its loan agreements. I like that they've repaid their line of credit earlier than its maturity date, showing good liquidity management. The key risks for them will be the performance of their portfolio companies. The interest rate environment and their ability Evergreen Credit can successfully manage its portfolio and make good on its loan agreements. I like that they've repaid their line of credit earlier than its maturity date, showing good liquidity management. The key risks for them will be the performance of their portfolio companies, the interest rate environment, and their ability to continue attracting new investment capital. Overall, what do you think of LAGO Evergreen Credit's financial health and strategy? Does their focus on private markets seem like a smart bet? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up. It really supports the channel. And remember to subscribe and hit that notification bell so you don't miss our next corporate deep dive. Also, be sure to join our Discord community linked in the description to keep the conversation going and get access to more exclusive content. Thanks for watching, everyone. See you in the next one.